Hey, Eric here from 5minuteinvesting.com and welcome to today's video, How to Invest in Stocks, a step-by-step guide for beginners. Now, investing is quite difficult. Now, when you're playing a sports, usually, you can play casually, you can play competitively, and even in competitive sports, there's multiple leagues, whether you have beginners, intermediate, advanced, national league, and world champion. But that's not how it works in the stock market. In the stock market, everyone plays together. You're in the same field. You have people that have supercomputers. You have people that have been investing for 30 years. You have pension funds. You have mutual funds. You have hedge funds. You get the idea. That's why investing is difficult. And when you are looking at investing, it's a game about information and anticipation. And when you're looking at investing, you're really competing at a great disadvantage. I'm talking about retail investors, because hedge funds or private equity funds can do so much more research, and mutual funds, of course, than the average investors like me and you. So this video is about how to invest in the stock market, and is a step-by-step guide for beginners. Now, let me just set your expectation on what you can expect when you're trying to invest in the stock market. Now, if you invest in some typical mutual fund and ETF funds, the average return for the stock market is around 7% per year for the last 30 years. So if you just choose a good mutual fund or a low-cost ETF funds that is in stocks, you should get around 6% because they take 1% management fee. Now, if you pick a mutual fund that is a mixture between bonds and stocks and real estate investment trusts or whatnot, then you can expect somewhere between 4 to 6% return a year. So if you decide to manage your own portfolio, if you decide to take this matter into your own hands and kind of control your financial destiny, then you should aim higher than 10%. Now, why is that? Because if you are really getting less than 10%, you're getting 6%, you're getting 7%, well, it's really not worth your effort, right? Because you can just invest in a mutual fund or an ETF fund and get the same result. So your effort is better spent elsewhere. So if you decide to manage your own portfolio, then you need to aim for higher than 10%. And that's going to require some insight. It's going to require some special technique. It's going to require a cohesive investing strategy. And that's what this video is about. I'm going to try to cram a lot of things I know into the next 10 to 20 minutes for you. All right, so let's go with step one. Now, step one is building your stock list. Now, this is not your portfolio. This is not, the stocks that you're going to invest in, but this is a stock that you're going to consider investing in. This is the list of stock you're going to watch. Now, ideally, if you're just starting out, you need 10 to 20 stocks that you like. Just add them on the list, whether you're using your iPhone or whether you're using some sort of stock tracking app, just add them. Now, how do you select these stocks? Now, here's a very simple rule for you. You want to select companies that you know, you like, you trust, and that you are a customer of. Now, this is quite important because when you're in the stock market, there are a lot of smart people. There are a lot of geniuses. There's a lot of engineers analyzing the markets. There are a lot of supercomputers. There are algorithms in the markets that are like trading constantly and making decisions in less than a second. So you want to have an information advantage over them. And you can do that by choosing companies you know, you like, you trust, and you're a customer of. Now, why is that? Let's say I'm an analyst and I do research over a company. I'm doing it from an outside in. I might be doing a research over a company for biomedical, and I have never used that product before. I don't know the company, so I need to do research on the strategy. I don't know, how management, or I have never visited a store, so I need to do all that research for that company from scratch. Now, for most of us, if you have a full-time job, you're not going to have that time to do ground-up research from scratch for a company. And by the time you do it and you decide that it is not a good fit for you, then you just wasted like 5 to 10 hours of your life doing research over a company that may or may not be a good buy. So you want to start with companies you know, you like, you trust. Now here are a few examples of stocks that are on my list. These are the companies that I know, I like, and I trust, and I'm a customer of. So I'm personally a big gamer. I love Star Wars. I love gaming. I have PS4. I have computers, games, and so on. So some of the stocks that I have on my list are Electronic Arts, EA, Activision and Blizzard. This is the one that has World of Warcraft in it. And I'm into computers, so I also have Intel, the microchip company, AMD, another chip company. And personally, I also love eating burgers, McDonald's, and so on. And I also have a company called Shake Shack, which is a burger company in the East Coast of the United States. So that is just a couple of examples of what I mean. Because, if EA, which is Electronic Arts, release a new game, I'll know about it naturally because I, watch YouTube videos or whatnot. If Activision and Blizzard comes up with a new game and it sucks, I would know about it because I play their games. And if they come up with a great game that people love, I would know about it as well because I will be the customer that is buying the game. Same for Intel, same for AMD and Shake Shack. And personally, I actually went to a Shake Shack in New York just to try it. And I see the lineup and there's 50 people lining up for Shake Shack at midnight in New York. So you can see why it is a very successful brand. So step number 2, finding a stock that is on a discount. Now, once you have your list of 20, maybe even 50 stocks, depending on how many companies you know, you go through that list. You go through and apply what I call technical analysis to find a stock that is on discount. Now, a lot of people is confused on this part, technical analysis, what it is, how do you use it, and there's a ton of information out there. And I actually released a series of videos that is about technical analysis on my channel, and you can watch it, you can search it. And if you go to the link below, I think it's the 3rd link or the 4th link, I also have a free course to set up your chart correctly for the first time, and in that free course, I teach you how to do technical analysis as well. But essentially, the goal of technical analysis in step 2 is to help you find a stock that is on a discount. So once you find a stock that is on a discount, you don't stop there. You got to keep going. And that will take you to step number 3, doing more research. Now, when you're looking at a stock, when you're analyzing a stock, you do not want to be limiting yourself to one analysis. Now, a lot of people, they look at technical analysis, they think it's at a discount, and they just stop there and they just enter. You gotta not do that. You gotta do a full 360 analysis. You gotta look at the financials, news, the company strategy, the products, new products, old products, and you perhaps want to do site visits as well. So let me dive a little bit deeper into each one of them and explain what I mean. So first, you want to look at news. What is the news around it? Is it good news? Is it bad news? How is that impacting the stock? The second one is financials. For financials, at the bare minimum, you need to look at income statements and balance sheets. And if you are more sophisticated, you want to look at ratios as well. Now, the last thing you want is to look at these separately or ignoring some of them without looking at them first. Now, what I mean is this. So a lot of people like to look at price to earnings ratio because it's one of the big ratios that is recommended by a lot of people. But if you look at that in silo, you're going to get misinformation. You're going to get confused very easily because a lot of companies manipulate that ratios because they know you look at it, because they know you look at that ratio. So you need to look at a lot of ratios and a lot of information sources and piece together your analysis. And that's why you can't rely on one single ratio. The next one is strategy. What's the company's strategy? How is that compare to competitors? And I think that's quite important. Is it winning? Is it losing? Is it going to do a turnaround? Depending on the company's strategy is going to impact your investment strategy as well. The next one is its products. Have you tried their products? Do you know if they're good? The last thing you want is to invest in a company with a shitty product because eventually the customer will always find out that the company has a shitty product and they'll essentially not buy it anymore, and that will lead to a decrease in revenue, and that will lead to a decrease in profit, and that will lead to a decrease in stock price. So you want to be trying their product, and this is why the first step that you're a customer, you want to invest in companies that you're a customer of, is so important. And finally, the last one is really site visits. Now, and for site visits, this really depends on your location. Right now I'm in Hong Kong, so I can't do as many site visits as I like. But for example, for Shake Shack, I actually visit their store in New York before buying. And I think it's quite important because when you visit a store, when you visit a company or whatnot, you can see the traffic, you can see how people are using the product, you can see how many people are crowding around the station. Like for example, if it is Apple, you can go to an Apple store, you can see a ton of people there versus you can go to another store, a competitor store, and you'll see that there's nobody there. So the fourth step, determine your portfolio allocation. Now you need to do a little bit more research on this, but a lot of people blindly follow the rule of top 100 companies, top 50 companies. The chances are, if you have a full-time job, if you are busy, whether you're a doctor, you're an engineer, you're a nurse, or you're a government worker, you don't have that much time to invest in top 50 to 100 companies. So you need to have a more focused and a more concentrated portfolio that you can invest, but with higher quality stocks and less stocks. So if you increase the quality of your stocks and you just pick the top 10 stocks, then perhaps you will get a better return than picking the top 50 stocks. Now, I might make a video on portfolio allocation someday, but as a quick rule of thumb, you should not invest more than 20% of your portfolio in a stock unless you know what you're doing. Okay, so the next one is develop a time horizon. Now, when you invest in a stock, it is important to know when you think it will hit your target price, when you think it will go up. Now, a lot of people think the moment they invest in a stock, it will go up. And that's not usually how it works. So you need to develop a time frame. So you might want to do this by looking at the trend historically. You might want to do this based on when you think certain events will happen. Now, in another video, I actually talk about the top 4 trends to pay attention to in 2020. So, for example, one of the trend is, the Trump election in 2020 in November. Now, I know Trump is going to go through the election in November. So that means I can work my way backwards and develop an expectation depending on my investing strategy. Like if I think this stock will go up because of the election, then voila. I can invest now, today, and I can expect to leave just before the election ends. So you can think about it that way. All right. And whatever your time horizon is, whether that is 6 months, 1 year, 2 years, hopefully, you're a long-term investor. Hopefully you want to be a long-term, laid-back, passive investor. So your time expectation is somewhere between 1 to 2 years or more. You want to double that. You want to give yourself more time. You want to double whatever you expect the stock will take to get to your target price. And the reason is because when you double it, let's say I think this stock will go up in 2 years, I double it, which is 4 years, I give myself more time mentally. And this really take care of your psychology because, let's say the stock will take 2 years to go up, but I think it will happen in 2 months. So that's unreasonable, right? Because the stock is not going to go up in 2 months when it's supposed to go up in 2 years. So if you double your time frame, because usually people are too optimistic about their estimate, then you will be in a much better mental state to invest in the market. Now the next step is number 6, is multiplying your profit. Now you would think that if you build your list, if you find a stock that's on a discount, if you do research, if you develop a time horizon and determine your portfolio allocation, you can buy today. Now that is generally true. And technically if you have done the first 5 steps, you can buy the stock. Now, if you want to multiply your profits, then you want to consider this step, which is using stock versus stock options. Now, a lot of you are not familiar with stock options, but essentially stock options is a way to multiply your profit. it's a form of leverage. So for example, if a stock goes up by 10%, then you can use stock options and you can possibly get 20%. And using this, what I call secret, I'm able to generate 50%, around 55% this year in 2019. And for the last 4 years, my annual average return is 50% a year. So using stock option is really a powerful tool, but you need to be very careful when you're using it. It allows you to multiply your return. So for the last 4 years, I'm able to make 450% from the stock market cumulatively using stock options. So if you know what you're doing, if you are familiar with stock options, then you can use it to multiply your profits. So if the stock will go up 20%, let's say, then you can expect a 40% gain using stock option. And that is really what separates a low return from a high return. And this goes back to my first point where I talk about if you invest in the market and you are making 7% or below, you should invest in a mutual fund. If you want to make higher than 10%, that's going to come from good research and a good stock selection. If you want to make more than 20%, maybe targeting 30%, and that's what I target on an annual basis, then you want to consider using stock options. So on a year-to-year basis, I target around 30% a year. That's my investment goal. That's my target. Now, sometimes I get more. So for example, this year I got around 50%, which is great. And I mainly use stock options to achieve that. And I do long-term investing. I don't do short-term. Now, finally, once you invest, your work is pretty much done, because once you invest, the money is in the market. It's out of your hands. All you're really doing is just watching. You're just watching the market. So it's pretty passive. So usually it will take you less than an hour a week. If you take more than 1 hour a week on investing, you're probably doing too much. So you want to reduce and you want to refine your strategy. So for myself, I take around an hour a week. That's pretty much it. A lot of people get surprised by how much time I take, but that's how much time I take for investing. So finally, once the opportunity has matured, the price has gone up, then you want to exit. And there are a couple of strategies to exit, but essentially one of the strategies is you want to set your target and you want to exit once the price hit your target, which is pretty straightforward. And sometimes the price will blow past your target, so you want to save some stock. You don't want to exit all at once. You want to save some stock for a little bit longer term than your target, so you can see if you can capture some additional profits if the price exceeds your target. So that's really the 6 steps or 7 steps I have laid out here for you, which is building your list, finding a stock on a discount, doing more research, determining your portfolio allocation, develop a time horizon, multiply your profits using stock options, and exit. And this kind of outlines my investing strategy. And my investing strategy is called long-term investing using stock options. And if you want to learn more about it, I have a 3-hour webinar below where I explain it in a little bit more detail. And it's one of the first link in the description. So you can click on it and join that webinar. So essentially for the last 4 years, I've been using this strategy and this strategy alone. And I'm able to make 450%. From the market, and that's an annual average return of around 50%. So that is pretty good. And as of today I'm recording this, it's a pretty good return. And I'm only a couple of days away from the year ending. So if you are interested in setting up your chart, learning more about technical analysis, there's also a free course link down below, which is trying one of the first modules of Investing Accelerator. And Investing Accelerator is a full step-by-step online coaching program I offer to people, to learn about investing. Whether you're a doctor, engineer, nurse, government worker, and you don't have any financial background, you can join this course and learn investing within the month. So in this course, I actually outline every single step I laid out here, but in much greater detail, a lot more examples, and there's going to be a lot of support for Investing Accelerator. So there are 3 parts to Investing Accelerator. The first part is the coaching program, where you will learn how to invest from scratch and learn how to target 30% of the market. The second part is once you learn investing, you're going to have some questions. You're going to be looking at stocks and you probably want a second opinion. So I have weekly group coaching calls to help you out and go through any stocks that you're looking at to give you a second opinion. Maybe you missed something, maybe you have some questions, maybe you want to see what other people are investing, or maybe you want to see what I'm investing. So that's what the weekly group coaching call covers. And finally, the third part is really the Facebook community. So I have a private Facebook community where all of the students, share the same strategy. Don't join this community, and you can see and interact with other students, and you can see what other students are investing as well. So that's really Investing Accelerator, and I explain a lot more in the webinar below. And afterwards, if you have any questions, you can schedule a phone consultation with me to chat about, if you have any questions about the program. So that's pretty much it for this video. And if you like this video, please click like, subscribe, and notification. And if you have any other topics you want me to cover, you can leave a comment below, and I usually get back to you pretty quickly. So that's pretty much it.